Today, we're talking trend lines, how to draw them, what they really represent, and how to use them in a way that could be profitable for you. I'm Jenks, this is the trading floor, and welcome to another episode of our Back to Basics series. Understanding trends is essential for successful day trading, and using trend lines can be one way to capitalize on them. Trends represent the general direction of an asset's price movement over a specific period. By identifying trends and drawing trend lines on price charts, we can gain valuable insights into where the market is headed and make more informed trading decisions. Trends can be uptrends, downtrends, or sideways. We usually call sideways trends consolidation. Uptrends occur when the price of an asset is making higher highs and higher lows. Downtrends occur when the price of an asset is making lower highs and lower lows. You'll notice price consolidate when the price of an asset is moving within a relatively narrow band. In fact, to make reading the price action easier during consolidation, traders often place a trend line on the top and the bottom of price. When we do this, it becomes easy to see how consolidation gets its other name, a trading range. Trends can last for days, weeks, months, or even years. The longer a trend lasts, the more significant it's considered to be. To draw a trend line, traders connect to multiple higher lows or lower highs. For an uptrend, the trend line is drawn connecting these higher lows. For a downtrend, the trend line is drawn connecting the lower highs. It's important to draw trend lines with multiple touches to validate their significance. A trend line with more touches is considered to be stronger than a trend line with fewer touches. There are two main types of trend trading strategies: trend following and trend reversal strategies. Trend following strategies involve trading in the direction of the established trend. This is done by buying in uptrends and selling in downtrends. Traders utilizing trend lines will often look for price to return or retrace to a trend line, then bounce off of it to continue the trend. Trend reversal strategies seek to capitalize on movements that go against the current trend or the movement that starts a new trend. Trendline traders will often utilize a method called the break and retest when trading reversals, but that's a topic for another video. It's important to practice sound risk management when executing trend trading strategies. This means setting stop loss orders and securing profits. Trend lines can often give good reference points to place stop losses, but it isn't perfect, and the big money players often use trend lines as liquidity for larger moves, so be careful if there haven't been any liquidity sweeps lately. To illustrate trend identification and trend trading strategies, let's take a look at a real-world example. In the following chart, we can see an example of an uptrend on the euro-dollar forex pair. The trend line is drawn connecting the higher lows. I start my trend at the lowest point in price and drag my next point to the next low. From there, you can see how price respects the trend line until it doesn't. In this example of a downtrend, notice how it's the lower highs that I've connected. This time I'm starting the trend line at the highest body closure, and I'm dragging my next point to the next body closure. Notice how price respects the trend line. Ultimately, it doesn't matter if you connect wicks or bodies to draw your trend lines. What matters is that you pick a method of drawing your trend lines and you keep consistent with it over a long stretch of time or data. But also just pick candle bodies. Most technical analysis traders spend at least some time learning divergences, and for those you'll connect candle bodies. But that's a topic for another video.